Hello and welcome to the Saltydog Investor. We will now look at how you can use the information that we provide to build your own portfolio. The main elements that determine the overall shape of any portfolio are your attitude to risk and the effect of current market conditions. By using the Saltydog groups, you can build a portfolio that not only matches your appetite for risk but also changes as market conditions vary. If you're unsure as to how the Saltydog groups work, then please look at our presentation on understanding the Saltydog groups. Your attitude to risk will depend on many factors, including how old you are and how long you're able to invest for, your family circumstances and the number of people who are financially dependent on you, whether you have a job or not and how secure you feel, how wealthy you are, your current and anticipated levels of income, and your financial knowledge. This list is not exhaustive, but gives an indication of the sort of factors that can affect how much risk you might be willing to take. Usually, the wealthier you are, the greater your financial knowledge and the longer you can invest for, the more risk you can afford to take. So how can the Saltydog groups help? Well, in very simple terms, to reduce the volatility in your portfolio, you have to increase the amount invested in the least volatile groups, safe haven and slow ahead. On the other hand, if you want to increase the volatility of your portfolio and the potential returns, you need to reduce the amount invested in the least volatile groups and focus more on the steady as she goes and full steam ahead groups. The first step in setting up your portfolio is defining some key parameters. We'll start with the easiest. This is the minimum risk that you are willing to take. This is how you would position your portfolio when markets are falling and your key concern is protecting your capital. In these circumstances, you would normally want to be 100% in safe haven or cash. Next is the maximum risk. This is the amount of volatility you are prepared to accept when the markets are doing well. It's much harder to define and is based on your circumstances and attitude to risk. To illustrate this, we will look at three hypothetical portfolios. The first and least volatile we will call the tug. We are showing it at its most aggressive, where it has 70% invested in the slow ahead group, 20% in the steady as she goes group, and 10% split across the full steam ahead groups and specialist sector. Even when the markets are performing well, the majority of this portfolio is invested in the slow ahead group. And the maximum amount invested in the full steam ahead groups and the specialist sector is limited to 10%. For an even more cautious portfolio, the amount in slow ahead could be increased even further at the expense of the more volatile groups. Now we will look at the ocean liner. We have deliberately increased the amount of volatility that we will allow. This should give better returns when markets are doing well, but could leave you more vulnerable if conditions take a sudden turn for the worst. Within the context of our three portfolios, this one is medium risk. Again, we are showing it at its most aggressive, where it has 50% invested in the slow ahead group, 30% in the steady as she goes group, and 20% split across the full steam ahead groups and the specialist sector. When markets are performing well, we are still keeping 50% in the slow ahead group, but are now allowing the amounts in the steady as she goes group to rise to 30% and the full steam ahead groups and specialist sector to 20%. Finally, we have the speedboat. This is the most volatile of the three portfolios. As before, we have shown it at its most aggressive, where it has only 30% invested in the slow ahead group, 20% in the steady as she goes group, and 50% split across the full steam ahead groups in the specialist sector. We are now allowing up to 50% to be invested in the more volatile full steam ahead groups and specialist sector. The minimum required in the safer slow ahead group has been dropped to 30%. For an even more aggressive portfolio, the amount in slow ahead could be reduced even further, and more invested into the steady as she goes and full steam ahead groups. Defining a static asset allocation is only half of the story. The key to being active is to fine-tune your portfolio as circumstances change. Having determined the parameters within which the portfolio will operate, the pie chart needs to be modified to take into account current market conditions. We believe that the only time to invest in the more volatile groups is when the returns consistently outperform those in the less volatile groups. How you judge the state of the markets is up to you, but within our own Saltydog portfolio we compare the relative 4-week performance of the leading sectors in each group. Returning to our hypothetical portfolios, let's consider how the ocean liner pie chart might vary under different market conditions. First we look at the hurricane. This is the default mayday position that all portfolios resort to in times of emergency. The entire investment is in cash or in the safe haven. The gale is next. When markets are falling but the end of the world is not nigh, the portfolio may take this position. The exact composition would depend on actual market conditions, but a significant proportion of the portfolio would still be in cash or the safe haven. However, when equity markets are struggling, some of the funds investing in bonds and gilts may still be providing steady positive returns, as may some of the absolute return funds. If this is the case, then it could be worth investing in the slow ahead group. Then there are the gold funds, which appear in the specialist sector. They sometimes do well when equity markets are falling, and so could form a small part of the portfolio. Hence the 5% shown in the specialist sector. As conditions improve, we move up to the gentle breeze. When the markets are relatively stable, the portfolio can move out of the safe haven group into the slow ahead group. There are many funds in this group which have historically shown little volatility and yet produce significantly higher returns than can be achieved in the safe haven group. The funds in the steady as she goes group may also do well. They have increased exposure to the equity markets and yet tend to focus on the more established companies paying higher dividends and the managed funds that have the advantage of a fund manager who should control the level of risk. In the longer term, growth is most likely to come from the full steam ahead groups and the specialist sector. If the numbers start showing some strong performing funds, now could be the time to dip a toe in the water. And finally the waters become calm. The sun's shining, the sky is blue, and all is well with the world. Global markets have returned to a period of sustained growth, and now is the time to fill your boots. The portfolio will take its most aggressive stance, with the minimum amount in the slow ahead group and the maximum amount in the full steam ahead group and specialist sector. You will have already set these minimums and maximums when determining your attitude to risk. As market conditions improve, the portfolio goes from its most defensive to its most aggressive state. I hope you now have a clearer understanding of how the Saltydog groups can help you build and manage your portfolio. As always, we would urge you to start slowly and only increase the volatility of your investments as your experience grows. If you have any questions, please get in contact. Thank you for watching and good luck with your investments.